Everyone, and welcome to Hong Leong Market Rhythms 2020. We apologize for the delay in starting. We had some technical difficulties on our end, but thank you very much for your patience and for spending your time with us this morning. Now, a couple of housekeeping matters to discuss. We're going to be opening the floor to questions throughout this webinar. So if you have any questions at any point, please do head on over to slido.com. Use the code HLBMR, which you should see on the bottom of your screen. Input the code and then send us your questions. There's no need to download any kind of app or log in at any point. Just use slido.com, the code HLBMR, send us your questions. Now, the reason why we're here, of course, is that we all have some level of uncertainty over what's going to happen in the future, what with Covid-19 on the cards and geopolitical tensions as well around the world. Even here in Malaysia, we've had a quite tumultuous year. And I think the question on everyone's mind is, what can we expect? Now, that's not an easy question to answer, but we're going to be taking a crack at it. First of all, with a number of presentations by our experts we've lined up for you this morning. First, we're going to be taking a look at it from a global perspective. Then we'll be zooming in to Asia, and then finally to our very own home Malaysian market. So, in order to kick us off, I think we're going to be having our first presentation this morning from Josephine Lip, Head of Business at Schroders Investment Management, here on behalf of Principal Asset Management in just a bit. Josephine, thank you so much for joining us this morning.
Good morning, Lynn. Thank you for inviting.
So you're going to be talking to us a little bit about a global economic market outlook. So without further ado, why don't you take it away?
Thank you, Lynn. Good morning, ladies and gentlemen. I'm Jo here from Schroders, and today I'll be speaking for Principal Asset Management, sharing with you the global economic and market outlook, giving you some sense and direction to see where the markets will be moving ahead towards, to whether it's up or down, or are we expecting the correction to continue. So let's look at the global economic outlook first. We have actually, including all Malaysians and globally everywhere, everyone have come out of lockdown, and we have seen lockdowns being eased around the world, and most of the countries today are in phase 2 of the COVID-19 pandemic. That is the recovery phase. Many questions were posted as to whether the recovery will be a V-shape, U-shape, square root, or W shape, where we are most afraid of. Right now, what we can see, a lot of it are slightly a bit of V and maybe a bit of square root. But one good news is that at Schroders, we are actually upgrading our GDP forecast for the rest of the year. That means we are a little bit more optimistic right now with the global recovery during this period of lockdown easing. We've seen some pent-up effect in demand for goods. People are coming back up to do their shopping, to do some local traveling and things like that. One of the data that has surprised us quite a bit would be in the US, where data has picked up quite well in terms of economic activity. Of course, in China, everything has almost normalized to the fullest, from traffic activities, manufacturing activities, and even to the movement, mobility of people all around China. So right now, we are forecasting a contraction of just about minus 4.6 in terms of global GDP. Previously, we were less optimistic. It was at minus 5.6. So we see a pickup in terms of a positive 1% for the overall economy. For next year, we are expecting about 5.1% in terms of GDP growth. It's why such a positive number. A few things, of course, we expect the recovery to continue. One of the expectation that we have moving into next year would be that there will be a vaccine discovery by middle of next year. So this gives us a more positive outlook moving into 2021. Of course, we're not totally out of the woods yet, but even if there is a second wave or the third wave, we do think that countries, governments, medical staff, or many of us who are in this new norm are better prepared. And also right now, even though we see high level of infection rates around the world, fatality rates are actually a lot less. So we do think the world are more prepared moving forward. Major lockdowns other than those that we are seeing across Melbourne or in Hong Kong, there'll be less and less of it. So therefore, a more positive forecast moving forward. And in terms of mobility data, if we track the frequency of people traveling in and out within UK, Germany, Spain, across Europe, and even in activities in China, what you can see, all this are moving on with a pent-up effect. Of course, activities have moderated to a certain extent. Services sector like airlines are still suffering. International traveling is not happening anytime soon. So there are some areas where we can see there'll be a lot of losers in terms of the COVID-19 pandemic, but from an investment point of view, we could still find plenty of lockdown winners right now. And of course, the direction of travel, the direction of the economic GDP globally would also make us a little bit more optimistic in terms of investment opportunities. So this is where we are in terms of the Chinese economic GDP shape. I mean, in the shape of the Chinese recovery right now that you can see on this chart. Industrial production, fixed asset investment, retail sales all have picked up accordingly, and we hope this can carry on. And we are a little bit more bullish in terms of the global forecast, like I said earlier, a little bit more reflationary moving forward. And one of the things that we are watching out for in the final quarter of this year would be the presidential election that's happening in the US. Our view is quite straightforward. We think Trump is expected to leave the White House. We do think that he's going to lose the next election that is happening on November 8th. Biden will take office. If Biden take office, what do we expect to happen? Markets could be a little bit more slightly choppy or a little bit up and down in the beginning, but with the level of liquidity that we see now that is supporting the market, we think that could help support the market. So short term, if Biden wins, market should be a little bit more choppy. But in terms of policy, you will see some level of taxes being increased, corporate taxes increase, regulation also increase as well. So we got to watch out for this. But we do think Congress will still be very, very much divided. So that would mean that if the Biden administration were to want to implement or launch any new stimulus or packages or programs, then they have to fight it off with the Senate. I mean, in the US, the House of Representatives are ruled by the Democrats, while the Senate is dominated by the Republicans. So this means policies may be a little bit more difficult to be implemented or to be established. Nevertheless, whether it's Biden or Trump, around the world, we still expect fiscal and central bank support to remain very, very powerful and remain very unprecedented in terms of stimulus packages, because what everyone really wants to get out of is to recover well from the pandemic. And we're not totally out of the woods yet, like I said, but in terms of government, policymakers, they still would ensure that stimulus is still there. And that would mean abundant liquidity. We are in this time where we think that interest rates will still remain very, very low, pinned to the floor for the next 1 or 2 years. Even though markets have rallied, we do think markets can go on a little bit more. The recent correction is healthy. We do think it's pretty healthy, and there's still plenty of opportunities. But before I go on to the market, I want to share a little bit more also on the US dollar. The US dollar, we think, is expected to weaken due to the twin deficit situation in the US, and also for two other reasons. Number one, Biden is expected to take on the White House. So when that happens, we do think international relationship between the US and China and rest of the world would also improve. And when that happens, that removes a big part of the uncertainty in terms of US-China trade tension or tension amongst countries with the US. So that would mean the US dollar works less as a safe haven, so less demand for the dollar. So that's the other reason why we think the US dollar is expected to weaken further moving into towards the end of the year. In terms of financial markets, like I said earlier, stimulus program, unprecedented monetary easing, all this will continue. And if you look at this particular chart here, right now, government bond yields, safe haven, treasuries, all are not giving you much money. I mean, if you just park your money into safe haven treasuries or even in our Malaysian fixed deposit, you're not going to get much. I think in Malaysia today, FD rates are only about 1.5% in ringgit. That's one of the historical low level. If you look at government safe haven securities, today also is not yielding a lot. It's only giving us a yield of about 0.6% if you look at the chart on the right. And it is much, much, much lower than during the period of the global financial crisis, and even during the period of the Great Depression, all the way back to the 1929. So what this should tell us is, even though markets have gone up a little bit recently, but when you compare it to what you can get from your FD, it still makes sense, all right, to be invested into equity market or even the credit market moving into the next 2 years. All right. Valuations, not everything is cheap. If you talk about tech stocks, it's pretty expensive. Healthcare stocks have rallied too strongly as well. Of course, the US equities, some of us are also pretty wary about the valuation point. But the world is so big, there's plenty of opportunities. Even if you talk about US today, there are other areas that we can invest in. I mean, the US market is not just about stocks. You have industrial companies that you can look at. I mean, instead of buying a Facebook or the FANG stocks, we buy aircon manufacturers. And why do we buy a big aircon manufacturing company? Why do we like it? The reason is very simple. We see it as a lockdown winner because big industrial companies that produces aircon for data centers is a big lockdown winner. I mean, that's a great example that we can share with you. In the US also, we are buying boat making companies. Why? Because we see that the demand for boat has increased. Recreational boat actually has increased. And why is that so? Because a lot of people, when they go into the water, they do not have to be following a lot of SOPs, unlike when we go into the shopping malls. And what we see is that the demand for boats have increased. And that's one interesting story that we can share with you here today. And this is are the stories that we share with our investors. While we see that valuation at the high level seems to be expensive, but there are plenty of stocks around the world, and even in Asia, which my fellow presenter will share with you later on, there are plenty of opportunities for us and plenty of reasons for us to stay invested in the stock market. One of the areas that we like is the Greater China Equity Region. And in this particular slide, you can see we're talking about the Golden Dragon Index, which represents the Greater China region, represented by Hong Kong, represented by Taiwan, and of course, China. It is reasonable in terms of valuation compared to the tech sector, which has become expensive, or even the US, global equities that has become a little bit more pricey at this entry point. But the Greater China region, driven by the three economies of China, Hong Kong, and Taiwan, we see this as a good source of making money right now, especially when the market have recently corrected. China, obviously, we know that it is the Taikor. It is still going to grow moving forward. It is not with or without COVID. China will continue to be one of the most dominant economies moving forward. Hong Kong, yes, they have some issues domestically, But in terms of Hong Kong, one of the great stories we like about Hong Kong is that it is still a gateway for capital in terms of capital markets for China. We are seeing high level of IPO of Chinese companies happening in Hong Kong. You know the northbound, southbound connect, the bond connect, all this are still happening in Hong Kong. So Hong Kong as a financial center in Northern Asia remains a key economy, key country. All right, key position. That's what I'm trying to say. And Taiwan. Why we like to talk about Taiwan, where everybody do not know much about, a lot of people do not know much about, is that Taiwan didn't really suffer any COVID-19 lockdown compared to other countries around the world. And Taiwan is also another winner coming out from this particular pandemic, because Taiwan is a global leader in making hardware technology, hardware tech, from your laptop to your mouse to components, all right, that we use in hardware technology, all right. So, and what we have seen happening is that with this new norm of working from home happening globally, we see a strong demand pickup for hardware technology accelerated by COVID-19. So Taiwan, being a global leader in this particular sector, is actually benefiting, and I can say that Taiwan is a lockdown winner in the current situation. So that's why when we talk about Greater China region, you can diversify your investment across China, Taiwan, and Hong Kong for the reasons that I've mentioned. And we see this as a way for you to make money over the next 1 to 2 years if you are interested in benefiting from this this region's growth story. And finally, gold. Gold is another asset class that we like. In fact, our outlook is pretty bullish. We are looking at an outlook of about $2,500 over the next 1 year from the level today. Why is it so? Primarily driven by the negative real interest rate environment. I mean, around the world today, the real rate, we are not experiencing any real rates at all. All right, meaning in the US, across Europe, interest rates today are all at negative levels. In Malaysia, like I said earlier, it's just 1.5%. Net of inflation, you are not getting any positive real rates in your pocket. So as a result, we see the demand for gold increasing. Also, the demand from central banks around the world as well. So the outlook for gold is quite positive from Schroders' point of view. So with that, I've come to the end of I've come to the final slides for my presentation. So what we see today here is, in terms of scenario analysis, even though there is a second wave, even though there could be a risk of a second wave, but we do think that the world is a lot more prepared if it comes. And in terms of global growth forecast, we see it tilted more to a reflationary trend. All right. The biggest risk to the world is a W-shaped recovery. All right, a third or fourth wave a third wave which could hamper the current recovery that is happening, but we don't see that happening. We expect a vaccine to be delivered by the middle of next year, and this could help help deliver global recovery at about 5.1% in 2021. But in the meantime, the long-term liquidity theme continues because the market is just full of cash, and this will continue to support the equity market. So with that, ladies and gentlemen, thank you for listening in and tuning in, and I would like to pass the floor back to Lynn.
All right. Well, thank you very much, Joe, for that presentation. So there were a couple of interesting things that I picked up from Joe's slides, including the fact that she expects the GDP for this year globally to come in at about a contraction of 4.6%. Nevertheless, still an improvement over their previous forecast of negative 5.6%. And of course, we're all very interested in the outcome of the US elections and what kind of an impact that will have on markets. But nevertheless, Joe does see some areas of positivity, including particularly in the Greater China region. But now we're going to be zooming in to closer to home in the Asian region with our next panelist, who will be giving her presentation in just a bit. So that will be Angie Tan, Senior Portfolio Manager at Affin Hwang Asset Management. So stay tuned. And we're back with Angie this morning, who's going to be giving us a regional perspective on markets. Angie, welcome very much to the stage this morning.
Hi, good morning, Lynn.
Now remember, if you have any questions at all during the presentations, do send us in your questions on slido.com, and we'll be addressing them after all the presentations are complete in a half-hour Q&A session at the end of this webinar. But now, Angie, it's my pleasure to say, please take it away.
Thank you, Lynn. Hi, good morning, everyone. Today, what I'll cover is COVID developments in Asia, and then I'll talk about some of the medium to long-term impact of what is happening today. And also, I'll end it with some of the key takeaways that shapes our investment strategy. Okay, just starting off with COVID developments in Asia, there are two groups of countries in Asia. So the first group, where most of the Asian countries fall into. So this group has actually managed the first wave quite well. They're going through the second and third waves, but the second and third waves have also been contained very well. And then we have another group of countries such as India, Indonesia, and Philippines. And these countries are actually still struggling to contain the first wave. But what they have in common is, most of the countries in Asia has actually eased the aggressive lockdowns that were imposed in the second quarter. Including countries like India and Indonesia, who are still seeing a high level of daily new cases. So post the easing of the lockdowns, we have seen mobility improve across Asia, but that improvement has actually eased because as new waves come, new restrictions are being put in place. The good news is that we have not seen mobility collapse all the way back to what we saw in the second quarter because governments have actually avoided imposing very aggressive lockdowns because of the negative social and economic impact from such measures. And so monetary and fiscal policies have been unprecedented during this pandemic, even in Asia, and this has actually stoked a rally in risk assets. So if we look at Asia, up to 9% of GDP in both fiscal and non-fiscal measures have actually been announced. And this will actually take Asia ex-Japan's fiscal deficit to 12.9% this year. And this is actually higher than what we saw during the global financial crisis. We do expect these expansionary policies to continue as long as the pandemic is not over. And if you look at data like inflation, current account balances, and leverage levels in Asia, they are all pretty healthy. So Asia should be able to fund this fiscal stimulus. And also, if you look at on the chart on the right, you can see that for next year, the fiscal deficit will remain quite high. In terms of monetary policy, historically, when we had large major central bank balance sheet expansions, we see higher capital flows into Asia because of the hunt for yields. So this actually leads to currency appreciation, and then it lowers the risk premium, and this opens up more space for Asian central banks to actually cut rates. Okay. And because of these large measures as well as easing of the lockdowns, we've actually seen a rebound in economic activities across Asia. Even for countries like India and Indonesia, despite high cases, you can see on the right, when you look at the manufacturing PMI on a month-on-month basis, it has actually continued to improve. Consumer confidence is also slowly coming back. If you look at retail sales on the right, we have seen a recovery across a lot of the countries. And this is also because a lot of the consumers have actually benefited from, directly from the stimulus through, cash handouts, interest waivers, loan moratoriums, things like that. So policymakers, they are balancing, between allowing activities to resume and also managing the pandemic by using, more targeted and more localized measures whenever there is a new wave. And we do expect this rebound in economic activities to continue because policies remain easy, governments remain very supportive, and as long as there is no aggressive lockdowns, this should actually continue. Okay, so what are some of the medium to long-term impact, of what's happening today? So one is, of course, we'll see a rising debt to GDP level because governments have to borrow to fund all this fiscal stimulus. So the good news for Asia is that if you look at the chart on the right, public debt to GDP is actually quite healthy. So there's actually room to fund all this stimulus. But the negative impact from this is down the road, this represents a headwind for growth, and also it leaves less policy headroom, during the next crisis. So it is very important that, governments look for new areas of growth after this, and to try to grow productivity and, deleverage once this pandemic is under control. Okay, and secondly is, so COVID-19 has actually driven changes in, how things are done, and some of these are actually here to stay. For example, we've seen rising trends in e-commerce. Companies have actually spent money to upgrade their tech infrastructure as people work remotely. And also because of social distancing measures, we've seen companies spending more on automations. So some of these measures can actually lift productivity and efficiency in the long run and help to offset some of the potential growth headwinds, from rising leverage. Okay. And also, if you look at in Asia, policymakers have also refocused some of their efforts in this space. For example, China, they actually launched what they call a new infrastructure plan. Still focusing on 7 areas, including 5G, artificial intelligence, data centers, things like that. And also Singapore, in their more recent stimulus package, they are setting aside about 500 million to help companies in their digital transformation. So even smaller countries like Indonesia and Philippines, they're trying to put in some effort in digital transformation, with the help of the private sector. So the result from this will not be obvious in the short term, but we do think that these reforms are necessary for Asia to be competitive and to stay relevant in the long term. Okay. And thirdly is the US-China decoupling. So what COVID-19 has done is to extend the US-China tensions. But if we look at what are the longer-term impact on Asia, I think it is quite mixed. So firstly, the positive impact would be we would see more acceleration of the diversification of supply chain out of China into other Asia countries. But since the trade war began, we've not seen many beneficiaries from this. In terms of FDI flows, we've only seen countries like India, Vietnam, and Taiwan benefiting. I think it is still too early to tell, so we do expect this trend to continue. The not so positive part of it, the more negative impact is actually, so there are two. One is the reshoring by US firms. So this is moving manufacturing back to the US. And if you look at the increase in automation today, so there's less need for labor. So it may not be that expensive to be producing in US anymore. So what this means for Asia countries is there's actually less export growth opportunities. Okay. And secondly is because of what has happened to China, in the past 2 years because of the trade war. They've actually improved on their own competitiveness and also increased, localization. And as you can see, the global export share for China has actually increased despite the trade war. And this tells you that they have their competitiveness has actually increased, despite the trade war. So what this also means is that China's growth will become, less complementary for Asia in the long run. So what Asian countries will have to do is to reform and to open up further, so that, FDIs can come in and they can benefit further from the diversification of supply chains. Okay. Okay, I just spent a bit of time talking about earnings because this is one of the key drivers for equity markets. So in the more recent earnings results season, we actually saw quite decent earnings delivery from the Asian corporates. So we actually saw more companies beating expectations than missing expectations. However, not everyone is doing well. If you see here, those that actually beat are actually, companies in the food and staple segment, healthcare, software and services. And as you can imagine, these are companies that benefited from, the lockdowns. And also, if you look at the sectors that are more sensitive to the economic cycles, such as oil and gas, capital goods. So these companies, they didn't really do very well. Okay, but what this tells us is also, how one should position in the market. So for example, for us, we always like companies with circular growth drivers, as they continue to do well, in all cycles. And also, if this, positive earnings trends can continue, it is actually good for markets, and it's also important because given where valuations are today, the next kicker for markets would actually be earnings growth. Okay, and then couple this with easy money, and if the economy can continue to recover, so these factors would be positive for the equities market. Okay. Another thing that we monitor closely is actually vaccines and treatments. And so far, the news flow and progress on vaccines have actually been quite encouraging, except, of course, last few days we actually had some setback from AstraZeneca, who has actually, they had to pause trials because one of the volunteers actually fell sick. But the five global front runners, they are expected to have data readouts on their phase 3 trials by fourth quarter of this year, which could lead to a potential emergency use authorization issuance. So we could possibly have a vaccine as early as next year. Although we don't expect everyone to be vaccinated next year, but incrementally this will be a confidence booster for a further normalization of activities. Okay, so this is my last slide, and some of the key takeaways that shapes our investment strategy is, I think, firstly, don't fight the liquidity trend. It is powerful. Secondly, is to think longer term and look for growth. Look for companies with circular growth drivers, meaning companies that can grow across different cycles, and companies with sustainable returns on capital. And thirdly, we are conscious of a value rotation. There are some signs that it is already happening, but we need to be selective and be cautious in this space because the companies tend to be more cyclical. Yeah, so value has actually underperformed growth, for the longest time. But whether this rotation is sustainable really depends on where inflation and bond yields are, and also where the economic cycle is next year. Yeah, so that's it from me. Thank you for listening. Back to you, Lynn.
Thank you very much, Angie. So that was a very interesting presentation by Angie Tan of Affin Hwang Asset Management. There are a couple of things that I found particularly intriguing because she looked at the two different kinds of responses broadly that we've seen from Asian markets. Some currently have managed to weather a second and third wave. Others are still fighting the first wave of infections. But broadly, there doesn't seem to be an expectation that there will be general lockdowns lockdowns imposed once again, even if we do see a COVID spike in cases. And like Joe, Angie expects there to be potentially a vaccine announced by next year. So now we're going to be taking a look, zooming in even further into our home market here in Malaysia to see how all of this is impacting us as well. And I'm sure that's going to be a conversation of great interest to you. And for that, it's my pleasure to welcome Yu Junqiang, Fund Manager and Key Researcher with Hong Leong Asset Management. Junqiang, welcome to the show this morning. Thank you for joining us.
Pleasure. Morning.
So you have, I think, something to say that's going to be of very great interest to our listeners out there because you're going to be taking us through the market outlook for our Malaysian market. So please do take it away.
All right. Thank you, Lynn. I'll start off my presentation with, I think it's just to summarize back the earlier my fellow presenters was telling. I think, just make it short, I think the worst is over, but the best is yet to come. I think this will apply to Malaysian market as well. I think we have seen a worst in the period of March and April, where we saw a market sharp drop by almost 30%. And so in terms of the GDP-wise, we have seen our second quarter GDP down by about 17%. That was quite bad. But I believe that is behind us. I think looking forward, given that things are back to normalize, things are recovering, we are foreseeing more opportunities ahead in Malaysian markets. So let me go through my slides. First off, just to share with you guys in terms of the performance-wise on the equity market indices. You can see we have been recovering from the low in the March, more than double digit. Malaysia-wise, among the bright spot among the market, we have done well in terms of our return as compared to our peers. Of course, certain selected region in the Asia-wise is still in year-to-date negative. That's Hong Kong. The rest of it, you can see, pretty much recovered back to the 2019 level. And of course, mentioned by Joe earlier also, gold is one of the strong because asset class that has been performing very well, partly due to the weak US dollar, and also people look to hide for the safety. But I think the trend will be reversing. I think I hold a separate different view. In terms of gold, I think equities will outlast given the recovery in terms of the economic activities-wise. All right. As mentioned by Angie and also as Joe as well, China will be one of the leading indicator for the whole recovery in terms of the economic-wise. So they were the first one to get impacted by the COVID-19, but also thanks to the strong control measurements, very stringent checks through the technology apps that they have in China. China may be able to come out strong from the COVID-19. And looking at the GDP-wise, they managed to deliver a positive set of GDP growth, 3.2%, as opposed to drop by almost 6.8% in the first quarter. And the recent stats, or some of the economic indicators like PMI also showing very strong surge. I'll probably move on to the second one. You can see the chart on the left-hand side. The manufacturing and services PMI grew up quite strongly as well. And same goes to Korea, another region that have done well in terms of managing the outspread of this COVID-19. In terms of car sales and retail sales, that's back to a norm level in 2019. So I think these are two good examples for us that how we see Malaysia, if we manage to control the virus well, economic activities-wise, it will back to normalize. So this is things that we see second half of the year or first half of 2021 is a good thing that we can expect onwards. And then on the more holistic perspective on the global-wise, purchasing managers also back to the 50 level mark, which is a confidence point. And the semiconductor sales, as mentioned by Angie earlier, a lot of automation, transformation into digital, that have pushed a lot of these semiconductor sales. You can see sales-wise is a bit deep. The growth-wise deep in the period of April or May due to the lockdown. But once the ease of the lockdown, you can see the growth rate is start to recovering back again. So semicon sectors have done well, partly due to the expectations of them further delivering due to the pent-up demand that have been suffered during the COVID-19 lockdown period. All right, next, in terms of the rates, I think just now Andrew have shared quite a lot in terms of rates. Globally wise, central banks around the world have been cutting interest rates. Malaysia wise, I think we cut until 1.75. I think 2 days ago, our MPC meeting, Bank Negara decided to put a pause on the rate cut. I think it's a fair decision, given that we have gone through we are in the RMCO period. We are seeing factories are being opened back, shops are being opened back. But just, I think, past 2 days, I think we saw the news that in Kedah and Sabah, there are new surge of new cases. But overall, Malaysia-wise, we are still maintain very strong position. I think it's fair that Bank Negara pause the rate cut to let the effectiveness of rate cut to surface. If not, continue kind of rate cut may hold back the further investment by the business. I think that's a fair decision. But I think the tone-wise, interest rate will stay low for quite a period. This is very helpful for the equities market as well. That's why this slide, I think not just Malaysia, overall in the other countries in Southeast Asia, in US, rate cuts has been quite aggressive. I think this will be a key tone for the coming months until the COVID-19 is managed to be toned down completely. So back home, I think one of the sectors that have done very well, especially in Malaysia, is the glove sectors. One of the darling sectors right now, but not so in the month of August or September. It will slow down a bit. I think it's fair. People lock in their gains in terms of profit. So you can see KLCI-wise, we are in a very positive territory thanks to glove sectors due to the upsurge in the July month, given that there are very high expectations on their second quarter result. But I think retailers somehow over-expected the earnings because second quarter just the beginning of the period where they are exporting glove at a higher selling price. There will be more to come in the month of July onwards, which means the third quarter. As mentioned, as shared by some of the management of these top 4 glove companies, they are still expecting at least 40% ASP increase from the period of April to June. That's why we believe the sell down in the glove sectors right now is a good time to buy. We probably can pick up some of the names here, especially those with a good volume that they're able to serve the market. I think these are the sectors that we continue to like. As glove wise, many people say glove stocks are expensive, but if you take those glove sectors out from the KLCI, Malaysian markets remain very attractive in terms of the valuation wise. So as you can see, we are trading about 17 times price to earnings. As compared to average, we usually trade around 18 times. So there's a lot of big caps that still being at the undervalued position. For example, names like the banking sector, and some of the oil and gas names. Even the upstream sectors is being downbeaten due to the concerns of the lockdown. But we believe once the things are normalized and recovery takes place, the volume of them will start to picking up. And here goes that there's the upside potential for us. All right, as I mentioned, data improving. There was a big sharp decline in the month of April, but things just improved back once we're back to RMCO. When factories are back to operation, shops are open. You can see industrial-wise, manufacturing-wise, things are recovering. So PMI numbers is showing a very strong surge from there. So house view, I think this is last slide of my presentation. Just to summarize back, Malaysia-wise, we have done well in terms of containing the virus. Although recently back to the 3 digits, 182 cases on yesterday. Hopefully we can contain it very fast, given that we have contact tracing applications right now. Hopefully we can trace down those who have been sick and get treatments fast. Then we can declare we are free from COVID from now. Of course, we still have to stay vigilant, follow the protocol, follow SOPs, maintain the social distancing. And so thanks to those in the frontline workers, especially in the healthcare sectors, I think they have done a good job in making Malaysia a safe place to invest. And of course, interest rate-wise in Malaysia, we expect it to maintain low. There will be another MPC meeting in the month of November. But right now we think that given the stats, I think it's still subject to the statistics from our economic. If maintained very well, I think there's no need for further rate cut at this juncture, which is why interest rate will stay low, which is enough and accommodative to the markets. So we still maintain bullish. I think another big event for Malaysia is the coming budget. As mentioned by our Finance Minister, Tunku Zafro, I think he has shared quite details that once lockdowns ease, more fiscal stimulus will be rolled out to support the growth. And also, he even give up a very strong numbers. I think he's expecting 8% growth for Malaysia's GDP in next year. So for us, looking at a longer horizon-wise, post-COVID-19 period is a good time to invest. And also, I think just now, NG also mentioned about the big trend about the flows. And also, I think Joe also mentioned that regarding on the flows, the liquidity flows. I think we are entering the so-called the economic cycle of asset reflation period. So we advise investors not to concentrate too much of your wealth or savings in just pure deposits. Try to diversify yourself in some into equities. Of course, subject to your risk appetite. It can be a balanced approach, some to the fixed income market as well. So these are the areas that we would like to emphasize for today. Of course, more equities-wise, certain economic growth we foresee will recover. That will benefit banks, which has been very downbeaten. I think the second Q result was quite bad. Some banks even suspended their dividend payout. But I think once they're able to assess the impact of this loan moratorium period, if the capital ratio is able to support, I think they'll be back on the dividend payout. Oil and gas sectors was a downbeaten sectors as well. But given the oil price has recovered to around $40 per barrel, some of them are back into the profit. And some of the maintenance job has been delivered out as well. I think oil and gas sectors pick those with very good capabilities and order books in hand. We'll see some recovery as well. Of course, we still like rubber glove, the healthcare stocks. We think the growth will outweigh the valuation in the future, which we still continue to like, and expect a very good dividend payout from them as well. So lastly, not to forget, given current low interest rate environment, stay invest in those high dividend yield stocks. We believe the trend of yield compression will come. There's a kind of low risk, and also we can foresee a better returns kind of sectors to play on. That's it for me. I'll pass back to Lynn.
All right. Thank you very much, Jun Chiang, for that presentation. I think it was very insightful, and there are a lot of interesting points there. Probably the most positive being the fact that Jun Chiang expects a recovery to come in the second half of this year, and doesn't really expect another rate cut come the next Bank Negara Monetary Policy Committee meeting, which is currently scheduled for November. So if you had questions, please do note them down, send them to us. So you can send that on through slido.com. And if you head on over to the website, you can use the code HLBMR. You don't have to log in, you don't have to download any apps. Just send us the messages and we'll be addressing them in a short while when I invite all three of our panelists back on stage to take your questions. And that's happening in just a bit, so be sure to stay tuned. All right, and welcome back to all three of my panelists this morning, Joe, Angie, and Jun Chiang, who have respectively tackled the market outlook that we can expect from a global, regional, as well as a Malaysian market perspective. Now, we have a couple of questions from the floor for the three of you this morning, building off of the information that you've given us through your presentations. The first question that we have, in fact, is asking about the fact that most global markets appear to have already rebounded to near pre-COVID levels. So the question here is there still an upside? Will there be any correction to global markets? Joe, perhaps you'd like to take this question.
Thanks, Lynn. Thanks for the question. Well, what has driven the markets so far is really the liquidity and the stimulus. And of course, a lot of investors are willing to look past the weakness in terms of the earnings for this year. They are looking towards next year. That is where we have where things recover, and the earnings outlook would be a lot more positive. So if there, and in terms of the current correction, whatnot, I mean, if there's no correction, it's even more scary. That means the downside is high. The risk to the downside is high. But if there's, now that we have seen some profit taking, we do think that for selected sectors, there will be room for entry.
And what sectors would those be?
It's a variety. I mean, if you look at, like what I was saying during my presentation just now in the US, the FANGs are a little bit too expensive, but tech has become a bit too expensive together with the healthcare sectors, but we like the industrial sectors. The industrial sector is one, driven by fiscal stimulus spending, infrastructure-related spending. Then we also like some consumer discretionary companies as well. So when it comes to industrial sectors, we were talking about aircon manufacturers. All right, industrial aircon, they produce a big-time aircon for what you call data centers. So we see the increasing demand for cloud services, increasing demand for data centers. So we don't just buy the tech company, right? We buy the supply chain that are selling to the tech sector. So, what do you call, the aircon company here is a beneficiary of a COVID-19 pandemic. All right, then we have other supply chain, other companies within the supply chain as well. Companies that make components, all right, that supplies to the data center. So we invest in companies like this. And as I was talking earlier in the presentation, consumer discretionary sectors are something that we like today as well. Boat companies in the US, medium, small cap companies, they make recreational boats because when you go to the water, there's no SOP. I really like this idea when my fund manager in New York talked to me about it, right? I mean, every one of us are so afraid, oh, you know, there's such high unemployment in America, they're not spending. But actually, people, not everyone is without a job, all right? There's a big middle class population in the US, so they are buying boats. In fact, in Malaysia, we see increased rental in yachts, in yachts. All right, in places like KK or places near the sea, because obviously there's no SOP, all right, in the water. So a lot of opportunities still in the supply chain. I mean, what else can it be? Perhaps you want to share something, Angie, in terms of
whether or not there's going to be an upside that you see, and any sectors that you like in particular?
Maybe just on the markets first, if I may add, although we are also positive in the long term because of the easy money, earnings are improving, economy is recovering, but I think in the short term, we do see some headwinds. So one is being the US potential fiscal cliff in the US, and also with the upcoming presidential elections, we do expect Donald Trump to be even more hawkish on China, so that could create some G3 sentiments. So I think in the short term we are a bit more cautious, but we see this as a buying opportunity. Yeah.
Talking about being cautious, well, for us, while we stay cautious, what we do is we buy a bit more defensive growth stocks, stocks that can still grow, but it's on a more defensive growth approach. Yeah. So because we see this rotation coming, perhaps we would look into more defensive growth stocks, and maybe later on, moving into next year, we see the income theme coming back. These would be the sectors that we're looking at. Yeah.
But so Angie, you mentioned the term easy money, and of course there are those who would say that the easy money has already been made. You know, seeing as we are quite far away from the lows that we saw in March when the scale of the COVID-19 pandemic really hit global markets. So, you know, what are the areas that you see potentially still having that kind of a wiggle room?
Actually, if you look at the markets this year, is the U.S. market has done really well. And when you look at the Asian markets, actually a lot of the markets are actually down on a year-to-date basis. And a lot of, basically the market performance has been very concentrated this year. So if you look at within Asia, it's the tech names that has done well, the internet names that has done well, selected consumers in China has done well. So we think that if the economic recovery can continue and it broadens out, then you know, the market performance should also broaden out. So one of the ways to play this is actually through the what we call the reopening plays. So companies that was affected during you know, the pandemic, and as the economy slowly recovers, business can resume. So some of these are like, you know, transport companies. They used to be very defensive, but because during the lockdown, people just don't travel. So as the lockdowns are eased, you know, people are moving again. So this is some of the examples. Yeah.
Now, Junqiang, there's another question as well that's been submitted by Kelv. And Kelv is asking, will there be any year-end rally with the scheduled vaccine approval? And I'm pointing this question at you because Joe and Angie have both shared their kind of expectations for when a vaccine may eventually come to market, but you haven't yet. So what are your thoughts on this?
On vaccine, well, of course, I agree with both. I think the top 5 are working very hard, relentlessly to look for the vaccines, and now it's in the third stage of the clinical trial period. Of course, that is somehow good to the overall market, but of course, Malaysia-wise, we're a bit unique because we have glove sectors as a component of the KLCI. Vaccine news, of course, is tilted a bit more negative to them. If COVID-19 able to control, the usage of gloves might coming down, but there could be another perspective on it because shared by some of the glove manufacturers as well. Because right now the inventory level not just in US, actually across the world, it's actually very low, which means some glove may just last them for about a week or two kind of period. I think that will take time for them to restore back to the so-called the strategic inventory level. That's why they are still seeing the demand can maintain until first half of 2021. So I'm not too disturbed by the vaccine news. Of course, if vaccine can be publicly available, most of people are vaccinated, that is bring overall good to the market. And probably back to the earlier discussion, I think Malaysia-wise, we're still being undervested by the foreigners. Recent rally, partly because of the higher participation by our local retailers. If foreigners were to come back, as mentioned, if the valuation is very stretched in the US and the developed markets, emerging markets with healthier fundamentals, given our current account still remain positive, I think Malaysia is still quite a good attraction point to look at. There are some of the banks that's been trading below 1 times price to book. Fundamentally, look at the capital ratio, we're one of the healthiest among the region. I believe this is some of the catchment that we can see opportunities ahead.
Okay, and now we also have another question that's just come in from an anonymous listener, saying that, you know, the speakers so far, you've talked a lot about Taiwan and Korea, but the question here is, will Malaysia benefit from China's growth? And Angie, you made reference to this a little bit when you were talking about what Asian economies would need to do in order to really benefit from the diversification opportunities. But since we're specifically talking about Malaysia, Junqiang, perhaps you'd like to take this question.
Yeah, I think Malaysia-wise, we have been trading with China quite some time. I think we have one of the highest trading economies, a part of US, I think next in China. I think this trend is going to be continued. We can see more and more companies, especially right now we can see those semiconductors names. More and more are building relationship, even open the factories there, stay closer to their partners in China. So being part of the value chain, I think that's very crucial. Earlier, I think Malaysia, we have a benefit of quite a diverse kind of ethnic. We're able to ease very well with the Chinese counterparts. So these are some of the ways that I think Malaysia we have some key advantage from it. But of course, in future, not just in the semicon sectors, I think in terms of financial sectors as well, we are seeing the entering of Taobao, and also even the Alipay has been working with Touch and Go. I think that will bring more business or the volumes. And hopefully, after the COVID-19 is able to be eased, our borders are back to open, more tourism from China. We all know Chinese tourists are willing to spend one, so that will bring a lot of growth for tourism sectors. I think Malaysia-wise, in terms of opportunities, I think there's still a handful of opportunities that we can leverage from China. Of course, political-wise, we have to be very sensitive. As you all know, the trade tensions between US and China, some countries has been selecting their camps, but Malaysia-wise, I think being neutral is very important, because with China-wise, dealing with them, look at what happened to Korea when the missiles threats happened I think a few years back. So staying neutral on the political stance will be very, very crucial. That's why Malaysia-wise, I think right now we are in a very key advantage position as compared to other countries in our region. Yeah.
But considering that China is looking in the long term to become more self-sufficient, and we've seen China become a lot more competitive across a number of sectors, will Malaysia be well positioned to take advantage of that from an economic perspective? Or, I mean, for example, when we talked a little bit about earlier this year, who are the beneficiaries of the tensions? You know, a lot of the attention mostly was on Vietnam as compared to us here in Malaysia.
Yeah, correct. I think there's a fair point to be raised. I think being cheap to win the advantage, I think that's no longer the case when working with Chinese. I think right now, of course, a lot of outsourcing works have been given out due to the low value creation. But for Chinese that they looking to expand abroad, I think there's some of the key advantage that Malaysians have. I think middle income class is actually huge in Malaysia as compared to Indonesia. I think we are able to spend even right now. We see recently on the online promotions, you can see Taobao have actually opened up very big in terms of opportunities and also promotion, engage with our local retailers to do some of promotion online. So these are some of the few cases that we can see that Malaysia is actually working very well with China on this part. And of course, we can't always rely on that. Of course, we have to stick to our own advantage. I mentioned we have a very good middle income group. Education level-wise, we are done much better than the rest of the region. I think these are the few factors why we can compete and also complement to their growth and opportunities ahead.
So Angie, I also want to throw this to you, because you talked a bit about kind of the other economies in the Asian region. Compared to some of those economies, you know, how does Malaysia compare in terms of whether or not we'll be able to really benefit and take advantage of some of the latest policy decisions from China?
I do think that Malaysia actually does stand out in the region. I think, especially in terms of skilled labor, compared to other countries like Indonesia, Philippines, we could probably provide better skills. Also, I think another advantage that Malaysia has is infrastructure, better infrastructure developments, compared to, say, Indonesia. Yeah, I think in these two areas is where Malaysia, stand better chances. In terms of labor, yes, other countries, they may have cheaper labor, but I think if you look at how a lot of companies do their expansion, there's a lot of automation these days, so, labor may not be the number one consideration anymore.
Okay, and now also taking a look kind of on a broader, more global perspective, the other big kind of the other big elephant in the room that we have to acknowledge is the United States. And the US is heading into an election in November. Campaigning has become very intense indeed. And we have a question here, I think echoing probably the sentiment of a lot of people looking at what the US is going to, how the US is going to position itself post-election. The question is, if Biden takes office, do you think US-China trade tensions will ease and issues like Huawei and TikTok will come back to normal? I think this comes back to the fact that both the Republicans and Democrats have proven themselves to be China hawks. But with Biden in office, and Joe, since you made reference to the fact that you expect Biden to take the presidency, how different will it be compared to this Trump administration?
We feel that it would be slightly better, but because don't forget that's the phase 1 implementation that took place earlier this year. In terms of how much China need to be buying from the US. So if China falls behind in fulfilling that commitment, then Biden would need to make noise, because we don't think that can be abolished straight away, because he needs to balance his power in terms of this area without getting into tricky situation. So while he will be a little bit more friendly than Mr. Donald Trump, he still need to manage this political tension that is still there. It's not totally gone or over, or with regards to Huawei and TikTok. So whether they will remove the ban or not will also depend on how China fulfills to their commitment, because ultimately our view is that it is a political game. All right. The Democrats do not want to be accused of giving jobs back to the Chinese companies or whatnot, So that could be a weapon from the Republicans as well, I mean, do you guys want to add on to what I mentioned?
Sure. If I may add on, we think that Biden may dial down in terms of trade tariffs, but we do expect the tech war between US and China to actually continue, because there is a consensus in US to stem the rise of China. So what this means is the US-China decoupling in the tech sector will actually continue. Yeah.
Okay. And of course, when we talk about elections, there is also another message in here from another anonymous listener talking about hearing that a potential Malaysian election could happen by the end of this year. Now, this is obviously there has been a lot of speculation on when GE15 will actually take place, and we're heading into the Sabah elections as well, which people are watching quite closely by the end of this month. So, should we, for the meantime, avoid investing in Malaysia?
I think the talks of GE was quite heated. I think for the past 3 months, I think things a bit settled down after the Pakatan Harapan camp failed to decide who is the candidate for the Prime Minister. But of course, we try to stay politically neutral from here. We don't favor any camp. But overall wise, I believe one of the reasons why foreigners remain aside from Malaysian markets is partly due to the current situation of Malaysia political situation, where there's no clear indications that who might come up stronger in the coming election. So that's the one that you mentioned. The Sabah election will be a very strong indication. So the outcome will be closely monitored, not just by us local, but a lot of foreign investors as well. Whether to stay aside, I mean, looking at our current valuation of Malaysian market, we are not excessively valued. A lot of stocks, a lot of counters has still been undervalued. That's why we foresee that if things are able to stabilize after the GE, one political party or groups that are able to get stronger mandate, I think that will bring back the confidence of the foreigners as well. So for Malaysian-wise, if you understand the fundamentals of Malaysia, which remain healthy and solid, why not taking this opportunity, this window, and position yourself? Yeah. that's my view. Probably Angie or Joe might want to add on.
All right. Well, I mean, so the other thing that you've talked about when it comes to valuations, Jun Xiang, specifically looking at individual Malaysian sectors, you've come across very positive on banks because you believe that they are well positioned to take advantage of an upswing if once we do eventually see COVID-19 uncertainties die down. And we have a question from another listener asking, I suppose, challenging that and asking, aren't most Malaysian banks overvalued today? What are your thoughts?
I think overvalue, I think a bit puzzled. But banks-wise, the way we're looking at it, usually the metrics we use will be price to book. I think Malaysia has been all the while, Malaysian banks, on average, trading at least 1 times price to book, 5 years, 8 years, or 10 years kind of period. It's a very rare case that you see Malaysian banks trading below 1 times book, which means whatever they're holding now, actually mostly are cash and the deposits in hand. Able to lending out, I think that will be a benefit for the banks, how they make the money. Where I think we hold a bit contrarian view on the bank. Yes, the second Q earnings result is still quite bad. It's still negative. But the positive notes from the result, you can see Malaysian bank in terms of the capital ratio position, it's actually remained very healthy. Yeah, and of course it's a precautions kind of method that the Bank Negara hinted them to pause the dividend payout at the interim level. So once the loan moratorium has expired, the banks is in a better position to evaluate their book situation. So for us right now, I think the worst has been over. The period where during the loan moratorium, a lot of massive loss that are being made in some of the higher purchase area, I think that has been provided in their books. Hence, I believe from that onwards, if things are recovered better than the expectation, the provision will be reduced. That will be a earnings driver for the banks as well. And another part of it is you can see actually, another part of it is you can see actually the so-called price to book level is remained low for quite a period. That's why it's a good time to enter. I don't think it's excessively valued at this level. Even dividend payout, some may say, well, there's no dividends to be received on the interim, but I think once the assessment has been done on the books, I think that may be resumed for their final dividend. I think that may pay back again. Yeah. So that's my view on it. Yeah.
So when it comes to talking about investment mixes as well during this point in time, it's always good to have multiple kinds of assets in your portfolio in order to try and diversify some of the risk. And both you, Jun Xiang, as well as you, Joe, you both talked about gold in your presentations, and you have quite differing views. So we have a question here asking, between gold and currencies, how should one position their investment mix? Should we look at gold as just another currency when investing? And I guess I'd also just like to get your different takes on where gold is going in the foreseeable future. Joe, maybe we should start with you.
Gold obviously is a commodity, it's an asset class. Basically, gold doesn't earn anything. You buy it, it's just a...
it doesn't pay dividends.
It doesn't pay dividend, it doesn't pay interest at all. But what gold does is it's used as an insurance or to hedge against the up and downs of the markets. And because of the recent uncertainty that we're seeing, or potentially more uncertainty if there is, then so gold can be a safe haven to hedge against all this. But right now what we're seeing here is in terms of the trend versus the monetary conditions, real rates, for example, like I said earlier, people are not getting anything from the FD rates or treasury yields at all because it's so low. So gold as a store of value, all right, could help in that sense. And as a result, the demand has picked up. So what we do is, as fund managers, we hold gold as well within some of our portfolios, whether it's an equity fund or whether it's a mixed asset fund or within, of course, in our commodity fund. So we buy some, because the outlook is quite optimistic, and it serves as an insurance within some of our portfolios. So we have built in gold, and in view of this, the demand is expected to increase, and therefore the outlook that we have, I have mentioned at about 2005 US dollars. Yeah. So when you buy gold, you can buy the bullion or you can buy gold equities. Of course, gold equities, you definitely be subject to volatility, but if you look at some of the gold mining companies today, there are plenty of gold mining companies that have very strong fundamentals. Yeah.
And Jun Chiang, so
Yeah.
you weren't so bullish on gold.
Yeah.
What are your thoughts?
I think I'm not that bullish at this juncture as gold have reached a new high. I think a week or two earlier, it's touched on the 2000 level. I think that was a very strong performance ever since we were in the lockdown position. But when we see lockdown being eased, when fundamentally or economic-wise are reopened back, there's been normalization. I think when we see corporate earnings start to grow, where equity price start to move, I think that will be a very big offset to the gold price movement. As mentioned by Angie earlier, gold doesn't pay you dividends, doesn't generate any cash flow, while corporates, with those that have been very resilient and well positioned for the recovery, I think that's the asset class that may outperform the gold over the long run. As we've seen in the past crisis as well, yes, gold did make an impact at first, when the 08 and 09 crisis, but it just faltered down after that because equities has shown a stronger rally in terms of the earnings growth, and some of the, I think US-wise, you see a lot of share buybacks that move up the equities valuation as well. That's why I beg to differ. I think that I hold a rather not so optimistic view on the gold level. I still believe in equities over the long run. That's why I as an equities fund manager, that's usually we will buy gold when, as I mentioned by Angie, during the very volatile period. When volatile period started to ease, for me, as a investors wise, I will putting back positions in equities. So I still hold the view that over the long run, equities will outrun the gold price.
Joe, would you like to add anything onto that?
No, I'm fine. Yeah, I mean
Okay.
that's Schroeder's view.
Yeah.
I mean, with regards to gold, and of course, I mean to share with everyone. I mean, we do think inflation will come back as well.
Yes.
Because the level of money printing that has been happening. So when inflation comes back, this is also good news for gold. Yeah. So as a store of value, when inflation happens, when it happens, it's good news for commodities, and at the same time, it could be good news for gold. So I mean, moving ahead in the medium term, we are pretty optimistic about the gold price, and also that we see a lot of central bank buying. All right, why is because I mean the U.S. have been creating a lot of enemies with other countries like Russia, Turkey, or even China with the China tension and things like that. So central bank purchases of gold could also lift up the demand for gold price. Yeah.
All right, and of course, I guess the interest in gold initially stemmed from all of the uncertainty that surrounded, how long COVID-19 was going to last, how deep was the economic hole going to be, and to date, there are still fears that there could be a second or a third wave of infections across any of the economies across the world, particularly here in Malaysia. So we did have a question asking about whether or not fund managers are prepared for the possibility of a second or a third COVID wave. And for the three of you, how are you positioning yourselves amidst with that kind of shadow of uncertainty hanging over you? Maybe Angie, we could start with you since we've had Jun Xiang and Joe speaking.
Sure. When it comes to second and third waves, I think we have seen it in Asia, Hong Kong, Korea, and we've actually seen that the countries are actually better prepared. So the impact on the stock market from the second and third waves hasn't been very negative. So I guess the investors, they would still look at policies, whether it is still stimulative, our policymakers, are they tightening too quickly? So if you look at right now, policies are still very easy. So, which is why markets has been very resilient despite, in second, third waves in Asia. So when we look at it, when we look at how we are positioned, that's why, we remain quite optimistic in the long term. So we are riding through, some of this volatility, because for us, as long as the liquidity is there, we think equities will do well. Yeah.
Jun Chiang, perhaps you could also weigh in on this.
Yeah, I think it's a very interesting point where Angie brought up. I think it's depend on which countries. Like myself, I'm also running an ASEAN fund. So right now, I'm still stepping away from investing in Indonesia, which saw the announcing another round of lockdown again over the past week. But we saw the Jakarta market triggered the circuit breaker, which is down by almost 5-6% in a single day. That's why, as opposed to Hong Kong or South Korea, where when they have a second or third wave, it doesn't impact the market as much. So it's very subject to the trust over the government, whether they're able to manage the outspread again. And of course, some of the countries has been very well prepared, like Malaysia, even though we announced 3-digit cases on the daily basis again, but very swift action by the government to announce tighter the lockdown in those areas so that it won't outspread to other states. So I think that is very crucial. So for fund managers wise, we depend on, we judge based on the government ability to control the virus. And of course, sectors wise, we try to avoid or having lower position in those that are very sensitive to this COVID-19 impact. For example, like the tourism industry, aviation industry, these are still suffered until now as travel ban hasn't been lifted in most of the countries. But some of the sectors that we think when things are normalized, they will get benefited from it. Even certain smaller scale of lockdown may not harm the overall industry that much. I think we are okay continue to position in these kind of sectors. Yeah.
And Joe, perhaps you'd also like to take a crack at this question.
Can you repeat the question?
Sure.
I lost my train of thought.
Sure.
Yeah.
No, I guess it's how are we bracing ourselves for a second or a third possible wave of COVID infections?
Yeah. In the portfolio, right? How do we reduce the risk if the second? Apologies for that. What we have been for some of the equity portfolios, what we did was even for some of our China portfolios, we use gold. We've always invested about 2-3% in our gold mining. In gold mining companies. So that's what we did. For example, the greater equity China portfolio. And then for our mixed asset portfolios, we use a bit more cash as well, and some investment grade papers, investment grade bonds. That would be how we want to reduce the overall risk. And the other area that we see within a pure equity portfolio, we will buy a bit more defensive growth stocks. Yeah, we're not a big fan of value stocks right now. If you look at our portfolios, although some stocks are really cheap, nothing against banks, but we're not a big fan of banks right now. We seem to be having a lot of differing views today. Nothing against banks, but we're not a big fan of banks. So we cut down a lot on banks because low interest rate environment is not going to do well for banks at all. So we cut down on that. We cut down on energy as well for the time being. So that's how we do it. I mean, even for a global equity portfolio, if markets correct, you will be hit. Sure, you'll be hit. But the main thing is if markets are falling 10%, but you are whacked about 2-3%, at least investors feel a little bit more secure. What we want to build is resiliency within the portfolio. So we use gold, we buy a bit more defensive equities, we stay away from banks, stay away from energy sectors for now. If we think dividend stocks, which is the the cheaper area of the market, is reasonable for us to go in, then we may buy a bit more of that as well. Yeah.
And I guess the question, there is also a bit of a question over how deep might the hole be if we were to go into successive waves of COVID-19. So I think, Angie, in your presentation, you made reference to the fact that you don't really expect to see kind of the same scale of lockdowns in the Asian countries as we saw, obviously, at the start of the pandemic. So, say we were to see, more waves of COVID-19 coming up, particularly as we head into the end of the year. What kind of an impact realistically might there actually be? Take your time to answer. Are you all right? Are we okay? Okay, maybe we could.
I think it's the aircon.
It's a little bit cold this morning, but perhaps we could move first to Jun Qiang then.
Yeah, I think as I mentioned earlier, I think we are not seeing a nationwide kind of lockdown again. Even there's a lockdown, I think it will be tightened in a certain region. I think same goes to China. I think China earlier they also have some cases in the northern region, but the lockdown is very swift. I think the way China managed it is rather very efficient in controlling the outspread of the virus. That's why overall, even though now Europe is seeing the resurging of some of the cases again, I think in UK, Italy as well has been seeing the number of cases has been brought back up. But I hope with the SOP in place and we know the effectiveness of having a face mask on, that will stamp the virus down. And also with the vaccines that come to play in the near term, I think we won't see that outright kind of impact like what we've seen during the March and April period again. So as I mentioned at the beginning of my presentation, I think the worst is behind us. The best is yet to come, which focus on some of the sectors that are going to be beneficiaries or could see a rotation of the play. Some of the sectors have done very, very well. I mean, the tech names have done really well, but given the valuation has been stretched, investors may look for other opportunities. Yeah, so we may take a different view from there. Some of the contrarian play that may not be the mainstream yet, the banks and oil and gas.
We seem to have differing views.
Yeah. We've strategically placed you in opposite.
I think Malaysia sometimes is kind of unique, kind of investment atmosphere. There are not so much tech names for us to choose from, and even the local tech-related names has been doing very well as well. I think we position it ahead, but on valuation angle-wise, we think that a bit stretched. So we look for alternatives, which are the sectors that fundamentally is still okay, but valuation-wise has been so downbeaten. So we're willing to take some of a contrarian bet on that part. Yeah.
Angie, would you like to add on to this?
Sorry about that earlier, but let me just attempt this. So we do not expect more aggressive lockdowns because we saw the negative impact from such lockdown in the second quarter of this year. So countries would actually be have more targeted and more localized measures. Also, when you look at, I think what Joe talked about earlier, when you look at fatality rates, that has actually come down. This is also because the medical teams have been able to manage it better, and we've also saw better treatments actually came up. So all this would give governments more confidence to manage this with more targeted measures. Yeah.
All right. Well, thank you very much to all three of you for joining us on this Market Rhythms event this morning. It's been a pleasure having you all on the show. And of course, thank you very much to you at home listening to us for spending time with us this morning. If we didn't get to your question, we apologize, but a full list of the unanswered questions as well as a summary of this event will be published on the Hong Leong Bank website within the next day or so. And if you have any further inquiries, of course, please do click on the I'm interested button, which you will see on your screens. Give us your name and details, and someone will be back with you shortly. It's been a pleasure having you with us this morning. I'm Lynn Mark, and it's also been my pleasure to be your moderator today. Thank you very much for joining us.